So tell us how you and the team are like thinking about everything. What really matters? What are you waiting to see if it matters longer term?
I mean, similar to, what a lot of people are waiting to see the sort of scale and the persistence of this. And I think especially in market terms, and, these are always uncomfortable situations because you never want to have to think only in market and economic terms. There's always the humanity aspect.
Right.
But to some extent, they're actually tied together in terms of the economy, angle. So I do think that, from our standpoint, the ultimate impact to the U.S. economy, because that's ultimately, what we mainly focus on, but of course the global economy. I think that you could sort of see it in market pricing, both when we were going through the more aggressive risk-off scenario, but also even today, something like European natural gas futures versus U.S. I mean, you could see the more sharp decline in Europe versus what was happening, on the upside. That to me sort of explains and kind of hints at, the U.S. being a little bit more insulated relative to the rest of the world. But I do think it's, we have to keep in mind, even if oil were to not move much from here, it would still mark a pretty big increase over where we were just a couple of weeks ago.
Up like 60% year to date or something like that.
So the shock is still there. It's just obviously not as severe. So this is sort of where the emotional and psychological, part of it comes in. It's not 120, it's down to 80. But up from 60 is still pretty tough, especially for headline inflation.
Do you think stagflation? Do you even?
Well, to me, it depends on what definition of stagflation you want to assign, because if you were around in the 70s and the 80s and you use the unemployment rate plus the CPI rate as your definition of stagflation, we're still pretty far from that because unemployment is still quite low relative to history.
Right.
If you're going to use a time frame over the past, say, 6 months, and you're going to look directionally, where has inflation been trending, where has the labor market been trending, then you could say there has been a little bit of a stagflationary impulse because the unemployment rate has been grinding higher. Inflation's also been grinding higher, closer to 3%, a full percentage point above the Fed's target. So I think it just depends on, number one, the time frame you want to use, and then number two, also sort of the background conditions.
So which one do you use? So do you say yes or no?
I say there's certainly been an impulse of that. I think there's been sort of a hint of it and a tinge, but I don't think that it's anything to be alarm. It's not capital S stagflation in terms of the 70s or the 80s.
So how do you play this market, given that we've been dealing with so many bouts of uncertainty? I mean, this is not the first chapter of uncertainty that we've been seeing recently.
For us, we haven't really adjusted anything, and we don't suggest that clients do the same, especially in these kinds of instances.
Nothing since the start of the year.
No, I mean, we've sort of came into the year relatively constructive on, outside of the U.S. from a stock market perspective, not against the U.S., but we just felt that, given some of the growth impulses you're seeing around the world prior to this, especially in Europe and parts of Asia, the weak dollar story last year, of course, was a really huge support to ex-U.S. stocks. But we sort of felt that was transitioning a little bit to the growth side of things. So you started to see a little bit of a broader base of support. Still feel that way today. So we haven't really changed any of that. I think that from a broad perspective, somebody who's looking at a lot of this geopolitical instability, the framework that I've sort of used for myself, and I think that most people, hopefully it's helpful over the past year, has been this distinction between what is the front page risk and what is the bottom line risk. Because at the end of the day, as uncomfortable as it may seem, if you're looking at this in a dispassionate way like markets are, they're really only caring about how much of the hit to earnings is actually going to manifest, if at all. So if this is a short-term conflict, which yes, if we do get some energy spikes, not to be dismissed, but if it's ultimately not going to be a growth hit to the economy and just a little bit more of an inflation shock, I think that the market ultimately looks through that, as uncomfortable as it may be.
So how long does this war have to go on? Like, when do you guys start to say, okay.
Yeah. I mean, it's hard to, I think that a scenario of, Brent crude eventually creeping back up towards, I don't know, in the 80 to 90 range, but hovering there. I do think that puts more of a pinch on the consumer. And especially, I was actually just going through some great analysis from the Bloomberg economics team right before this, looking at sort of that break-even price for Brent and the tax refunds coming from the big, beautiful bill. And we're essentially right here at these levels at that break-even point. So I do think that it starts to eat into some of that stimulus that's coming to the consumer, especially a consumer base that is devoting a much higher share of their spending and their income on energy versus, the wealthier share.
So based on that potential bear case scenario, how would you strategically realign where you put your money, where you invest capital? Well,
I don't think that there needs to be some sort of major realignment. I think that the realignment would come if there was a big shift in the growth trajectory of the U.S. Because coming into this, as weak as the labor market has been and as fragile it's been, there were a lot of signs of some stabilization. Even if you take January and February combined for U.S. payrolls for both of those reports. I think you could make the case that, January was probably overstated in terms of the strength. February was overstated in terms of the weakness. So you add both of those together, you're probably close to that break-even rate for payrolls around 50,000, considering what the unemployment rate did for both. You have seen a little bit of a stabilization in private payrolls. Not to say that everything is totally fine, but I think some of that fragility was sort of easing by last fall. So as long as this shock doesn't affect that scenario and that picture for labor, which of course it could, but we haven't seen the signs yet because it hasn't been long enough for us to see. As long as that doesn't happen, then I don't think there needs to be some sort of major realignment for a portfolio.
What's more interesting to you? I mean, obviously we just talked about the war in Iran, and again, taking out the humanity and the cost of people and lives impacted as a result. But there's the AI trade. There's the worries about private credit. What is it that you think is something investors should pay more attention to? Just got about a minute or so left.
I think AI from the standpoint of how it's starting to move through the economy and move through the market. And one of the distinctions and sort of points of emphasis we've been making has been, if you do believe that it's starting to diffuse throughout the economy, you're starting to see a lot of the benefits of this technology and this capture. It may not be the best from a cap-weighted index perspective, because if you thought that tech and communication services were sort of the big drivers and the big players at the outset, not to say that they don't participate, but if they're taking a little bit more of a back seat, giving way to the rest of the market, so breadth looks relatively solid, those other parts of the market are just not as big to power your traditional, cap-weighted S&P 500 higher, at least to the degree that we've been used to over the past couple of years. So not to say that the market does poorly, but I think that's an aspect to consider if you're a believer that this continues to move throughout the economy and benefit, the rest of the market.
I agree with you. I feel like the AI conversation is changing in a big way, and I've had conversations about vertical AI and the large language models. Maybe, we could be moving off of that in a big way.